Welcome everyone to this episode of Manufacturing Talk Radio. I'm Tim Grady. I'm here with host Lou Weiss, who is the president of All Metals and Forge Group and the founder of Manufacturing Talk Radio. And our guest today is Tim Fiore, who is the committee chair for the Manufacturing Report on Business. He sits down with us every month, and the first of the month when they issue this report, to talk about how manufacturing is doing. Tim, thanks for joining us.
Yeah, good to be here, Tim and Lou. Good to see you guys.
Good seeing you.
Well, I trust the convention went well, and that you're getting a lot of good information. How is manufacturing doing at the moment?
Oh boy, so it's So let me start off with the good, and there's a lot of good here. And actually, you know the way it is with a bunch of variables. What you do with you eliminate the variables. You take them one of the. You got 10 variables. You take the one out. You get 9. Then you get 8. Then you're left with one variable. That one variable that we're kind of left with now is really, what does the future economy look like for the United States? That's the one variable, and that means we've solved a lot of the other variables: supply chain problems, hiring problems, capex, productivity, all that. We seem to have solved that. So let me kind of start off with saying that our production number, which is really a surrogate for revenue, came in at 51 and some change. So we're actually expanding our billings compared to April, which in a recessionary environment, you don't do that. You see a decline. So we all kind of focus on the new order number, which is the future primarily. It's not so much this month, it's really the future. And it's a concern because if new orders are drying up, you have an impact on backlog, which we'll talk about later. But the revenue at the meantime, go ahead.
And you're also going to have a negative impact on production in the future.
In the future, yes. Yeah. But in the meantime, you run a business, the way it is. You got expenses, you got to cover the expenses, and you hope to end up a little bit left over. Well, if your revenue is the same or better than the prior month, you're probably in a better position to do that. If your revenue is declining, it's a different conversation. Our hiring side, our quits rate stepped up a little bit in May compared to April, but not significantly. So we're back, and people are leaving jobs again, which is probably summer related. Some dynamic going on there. I think there's still a ton of concern about future economy, which I think is a natural headwind to people quitting a job, because if you're the last one in, you're the first one to get fired. But okay, so our headcount management levels are still very consistent in the last 5 months or so. We're still running a 1.4 to 1 hire versus force manage. Remember, we peaked at 20 to 1. We had 21 companies, 20 of them were hiring, only one was not. One was freezing, one was attriting, one was laying off. We're now sitting at somewhere around of 3 companies, 1.8% of them are hiring, the other 1.2% are trying to manage headcount down through attritions, freezes, and layoffs. So it's still in that same range. Too close for me to say it's really changed that much. But what I will say is that the percent on the headcount reduction level, the percent of layoffs of that has been very consistent for the last 4 or 5 months. So there hasn't been a wide scale effort of companies to lay off people. Now, you can ask yourself the question why that is. Revenues are still pretty good. You don't want to give away those people you worked really hard to get and then to train, because we know we hired a whole bunch of people that didn't even know their way to the restroom, let alone how to operate something. So we spent 6 to 9 months training them, and you don't want to let them go. And we started the year with a lumpy first half and a more optimistic second half, actually a pretty strong second half. The forecast update that we just released last month indicates that, well, maybe the second half is going to be more late in the second half. And I think we're probably easing closer and closer to Q4. Because I did get comments this month about first half of 2024 being recessionary. So this is all kind of a function of a soft landing versus a hard landing, which we'll get into before the show is over. So let me stay on the positives. So, the hire to force manage is still, pretty stable. Nobody's pulling the ripcord yet, primarily because the billings are still good. But remember, we're coming up to the end of Q2 and an announcement to investors about what the rest of the year looks like. So, and with the decline in backlog, it's going to be a really interesting conversation about what the panelist companies decide to tell people. But we'll get to that. So we got input material flowing the best it has since the pandemic. The material is flowing really well. Now, there are some exceptions, of course. We still have electrical components, electronic components that are still a problem 2.5 years later. The chips problem is not as bad, but it's still there. And over time, it'll diminish. But overall, the flow of material has been much better. We got manufacturing inventories contracting again in an environment where future demand is uncertain. Our billings currently are pretty stable. We all over ordered. We expected a bunch of that over ordering to end up in manufacturing inventory. It hasn't. And that's a direct result of a soft landing. The soft landing has given us all the time we needed to kind of work that off. And we've worked that off to the point where we're actually reducing our own inventory levels, which in a soft environment, you always see that number go up. So, okay, that's a positive. I mentioned export orders, I think. They're stable, 50. Last month, 49 and some change. So, and that's a big surprise, a big positive surprise, is that Europe and to some extent China is doing pretty well. It's not in the low 40s. So, all right, 20% of manufacturing GDP is exports. So it's good to know that that leg on the stool is doing pretty good. We got prices dropping in the low 40s. That's, we all want to see, unless costs drop, we're never going to see the bottom of this. And we haven't found the bottom yet, but with prices declining, that's very positive. I feel really good about that. And if you look at the fundamentals, most of it's probably commodity driven. Steel prices got too high again, $1,200 a short ton. Now the indications are it's coming down. Plant utilization is up in the high 70s again, which is good. Aluminum is coming down a bit. Copper declining, probably because China's not performing like people thought it would. So, and buyers are looking to load up their order books, so they're dropping prices, which is what you want. And then the final good thing here is that lead times are coming down. So 28% of my headline comments indicated that lead times were coming down. Finally, I think I've been reporting they're coming down for the last couple of months, but our numbers didn't show it. We took 8% off of the lead time, April to May. So, okay, you got prices coming down, you got lead times coming down, you got backlog really down. So let's get into the negatives. The negative here is that where's the demand? Where is it? We said this last month. People are still not placing orders. Sorry about the background noise. He'll move along here in a second. He's just so happy. He decided to cut underneath my window as I did my monologue here. All right, go ahead. keep moving. Keep moving. All right, hold on a second. Okay, I'm making noise.
Sorry, we don't hear
me. Am I good?
We hear you. We don't hear the lawnmower.
Oh, okay, good. Okay, good. Okay, so the downside is we got what 9 months, I think, nine months of weak new orders, and now another bad month of weak 42 and some change. That's pretty weak. That's not comforting. But you couple that with the fact that backlog now is 2009 levels. We haven't seen a backlog number since 2009 at that extent. That's alarming. So, as we talked about in the show, you got lead time, you got people working on backlog and working on their overdue in the absence of new orders. So we finally chewed up all of that backlog. Now, what do we do? What do we do? Without new orders coming back, then it's time to start looking at structural changes to your cost structure. So that's why I think, as we close first half here in June, we've had a good first half revenue wise. It exceeded expectations because the slow landing really just delayed a landing, whatever that landing is. We were hoping at the beginning of the year to go through the soft landing and start to take off before the half ended. That's not going to happen. So, now we have to look and say, look, my order book is thin. My backlog is gone. Everybody, the CEOs are going to look to their salespeople and say, what does the future look like? So, in June, in May, and in June, they're going to be on the phone constantly. I need orders. I need orders. Well, your prices are too high. Okay, I'll drop my prices. Well, your lead time is too high. Okay, I'll drop my lead time. All right, where's the orders? Well, I don't know. Maybe since I don't know what the future looks like, you're going to have to build the stuff yourself and hold on to it because I'm not committing to it. This is what's happening right now. Because in the absence of new orders and backlog coming back, I mean, if backlog hits 45 or less next month, oh boy. I mean, you got to hope that backlog is going to be 50 next month, and I don't think it's going to be. So you get all these CEOs going to their investors, whether it's a bank, a family, or a public company, and people are saying, what does the future look like? Geez, I don't know. So you got your sales guys trying to get more business. They'll be semi-successful. They won't be fully successful. And because their customers are going to turn to them and say, you go ahead and build it on your nickel. I'm not going to give you an order so you can ship it to me because I'm concerned about liquidity. So here we go. June and July is going to be fun. But the summary on all this, I think, is structurally, we've never been in a better position since the pandemic. Lead times are better. Prices are better. Suppliers are delivering faster. We got enough headcount. We got revenue at an acceptable level. So now it really just comes down to, and our inventory levels are low. Suppliers probably have quite a bit. The customers are claiming that they have too much. So where are we going to next?
To your point, and I know you don't like making predictions. Does this all mean that interest rates are not going to be increased this coming month?
I've had that question like 4 times today. And my answer to it is
original.
Yeah, my answer is I'll go with the consensus on that. I think there's 2 other questions, Lou. The first one is, how well is manufacturing positioned to respond to a growth or a decline? And I think the answer to that is we've never been better positioned for any change in the environment. And the second question is a soft landing good? And like we've talked about in the show several months, I'm not so sure. It's been good for the overordering position. It's been good for managing inventory across the entire greater supply chain, customers, panelists, their suppliers. But what it's resulted is a huge amount of uncertainty. So that in our forecast, we thought we were going to expand CapEx 6% 2020. We're now down a couple of tenths. So no CapEx, which means no new orders for capital equipment, for long life durable goods, not happening. So, okay, then, without knowing what the future looks like, are you going to hold on to those people when your backlog is gone and you don't have new orders coming in? I don't think you can.
So a headline for this show is, in spite of the ISM number continuing to drop, we've never been in a better position, which is a bit of a conflicting story, but would you agree with that comment?
Yeah, I would. We've never been in a better position to respond to growth or decline, ever. And well, in my 7 years doing this, we've never had everything, and the slow landing provided that. It gave us the ability to but the one thing that we've done outside of all of this is we've kept headcount. Overall, we've kept headcount. And that's because it was so painful to get the proper headcount over the last 2.5 years. Everybody was reluctant to let him go. And we were hoping that, we kind of come down into the trough, start to recover. We'd hold on to those people during that period because we got price growth through pass-throughs to customers. But now we're running out of order book and we still got the people. Where's the orders? So, and this has been going on easily since early April. Where's the orders? Where's the orders? Where's the orders? Right. So, and here we are now going into June, and the orders are not showing up. They're actually getting worse. The other thing I want to point out is, there's 5 criteria I'm watching here to indicate to me a recovery, and I think you get 3 of those 5 heading in the right direction, and it's starting to feel good. The first one is the percent of industries under 45, and we'll talk about that. I think that's a big indicator there. Second one is chemical products recovery. It's not recovering. So that means the underlying demand 6 tiers down in the bill of material is not materializing, which probably indicates that when it starts to materialize, we're probably a couple of months to maybe a quarter away from seeing it at the higher level industry sectors. The hire to fire ratio, we're not seeing more freezes, attritions, and layoffs than we are hiring. So that's negative. transportation disruptions, there aren't any transportation disruptions, no comments at all about transportation cost growth or being able to get equipment. So that's a negative too for growth. Until we start seeing that anxiety, we're not growing. Then the last one is manufacturing lead times. That's the only positive, is that for sure we got confirmation that lead times are coming down. So let's go back to the first one, the percent industries performing under 45, of their own PMI under 45. So we ended up at 31% in the month of May, up from 12%. That by itself doesn't worry me too much. We peaked out at 34%, I think, in December. What bothers me is that there are 2 or 3 big industry sectors, computer and electronics, food and beverage, that were like 45.4. Could have very easily been 44.9 or 45, which would have put it in the other bucket. But if it went into the other bucket, now we're talking 60% of manufacturing GDP declining under 45. Now that's warning bells. Those are warning bells. It's interesting because if I take the top 6 industry sectors and I look at their new order number, it absolutely mirrors the new order number for all 18 industry sectors. So if I watch these top 6, like I've said from the beginning, they're the bellwethers because they drive 70% of manufacturing GDP. And you get a couple more of them falling into 45 or less. Right now, the only one in there, I think, is, no, there's 2. One of them being chemical products. You get a couple more, you get computer and electronics, the number 1 industry sector, that's 16% falling in there. That 31 number now goes to 47. You get one other in there, call it food and beverage. No, food and beverage. That's throwing another 11% in. Now we're close to 60, and that's a warning. But the point on all this is that June's going to be a really interesting PMI month because we're properly positioned here. We're ready to go. I don't see a starter pulling a pistol. I don't see him shooting the gun and here we go in expansion. And I think this is a direct result of a soft landing that we still haven't landed yet.
To your point, June and July, August are not typically go get him and fire the pistol months. So we're facing not a real, I would think, we're not facing a real good expansion coming these next 3 summer months.
Yeah, you could argue. Good point, Lou. I mean, we might be in this thing until September, October that are pretty good manufacturing months.
Right. Exactly.
Yeah.
Exactly.
Yeah, you're right. You're right. Well, I think
Now,
next month I'll see more
by the
comments
way,
about recession in 2024.
One thing that I've noticed, I probably have never gotten as many emails from trucking companies asking if we have truckload quantities to go.
Yeah.
I must have gotten in the last 2 weeks 10, 15 emails from various trucking companies begging for business.
Right.
So that's also a signal.
Right. But I will say, based on my general knowledge, especially when I was with all the ISM people a couple of weeks ago, that new equipment in the transportation sector is still struggling. The automotive side is clearing up. I think there were 60 days inventory on lots, up from 20, which is probably a combination of them performing better on the delivery standpoint, as well as demand kind of softening a little bit because of interest rates. But the trucking side is more about, look, this equipment wears out. We need the new equipment. And I'm not hearing that it's really improving that much from the standpoint of on-time delivery and availability. I'm thinking that the lead times are still well in excess of normal, and that dealers still do not have trucks on their lots to sell to a walk-in customer. So, that in combination of the fact that you got probably independents or small companies out looking for work is
Right.
A bit alarming.
Tim, I'm just curious how aerospace is doing.
Yeah, it's I got a lot of comments. Really, I'm going to talk about the defense sector. I got several comments from panelists that have a strong defense book that indicated that orders are flowing, which I think is good. I'm surprised. It took this long to get replenishment orders in place for munitions and military gear after, all the depletion of the inventory we've gone through in a year. But okay, it's happening now, which is good. And it's flowing down through the supply chain. I mean, I think Aero is probably got to be 22% of transportation equipment. Transportation equipment is still positive. We're still expanding, not heavily, but we're still expanding. So, and they're still having trouble with deliveries, material deliveries. So, yeah, it's like the transportation equipment sector is still a little bit of an outlier compared to the other 17. Which is good.
How does consumer confidence figure in your report, Tim?
Well, it eventually makes its way to us, and I'm not sure what to say about sentiment and confidence. I mean, the people are. I think it kind of ties back to soft landing, hard landing. The longer you go on and not getting to the trough, the more people that are concerned about longer term debt for themselves. And we already talked about the housing industry being removed from super PCE because that's going to be impacted by interest rates, but it takes some time for rents to drop because people sign 1-year leases and stuff. So take that out if you really want to be in tune with what's happening with inflation. Take all that, take the food out, take the energy out, take the housing out, and see what's happening with PC. But we're still sitting at high threes, I think. So people are. I know it's mid-career with me. If I was sitting in today's environment, I probably would keep driving that car longer. I would not be out looking for a new house.
Right.
I just wouldn't because who knows what does the bottom look like? I don't think the bottom is going to be an ugly bottom. It's not like going through purgatory. I don't see the bottom like 2009 Great Recession where there's a huge amount of uncertainty because all the banks were collapsing. The foundation that capitalism lives on was crumbling. I don't see that happening. But I mean, I have a different attitude now towards what happens over the cycles. And if I'm a 35-year-old or a 40-year-old, I haven't built up that wisdom yet. And I'd be concerned about investments. And to the point where you might even be concerned about expenses like expensive trips and Disney World and overseas. You might, because who wants to end up eating white bread versus rye.
Well,
meanwhile, you hear with regards to the travel industry, they're all raving about what's going to be happening over the next 3 months.
Yeah, I think that's on Tony's side, that's really a positive thing. And I live near, in both my places. I live near a runway approach zone pretty much. I can see the aircraft, and I'll tell you, in the 1-year time where I'm at now, it's a big difference. There's a lot more planes coming in. Yeah, and peak pandemic is like, when is there a plane going to fly by? The only guys that flew by were UPS and FedEx. Now it's like and it comes in bunches, and there'll be 10 at a time, and so that's all good. But that's why let's finish the show here on the comments around: is a soft landing good or is a hard landing good? Hard landings are painful because people get separated, but they generally don't last as long, and you start talking about growth. Soft landings have a price to pay too, and that price is indecision. And that eventually, if you're not getting, and maybe a no landing, I don't know that a no landing will work, but if you think about this whole thing about getting to 2% and then the Fed will back off, but there won't be a lot of accommodative support by them like we've had for 10 years, buying bonds and things and zero interest rates. I may not see that for 15 years. But okay, with no landing, what happens here? So if you can stop the PCE, super PCE, from growing any more than 0.12% per month, then you're at your goal. You're at your goal. And I think right now, take 4 divided by 12, you're at 0.3. So, they in rough numbers. So they still need to get to no more than a 0.12 or 0.14% growth month to month. And when they get there, we're home, and then they'll no more interest rate increases. I don't see them dropping them right away. because they'll give that some time to kind of work its way out. You know, and the Fed balance sheet hasn't really played into this yet. We're still sitting at $8.7 trillion of US owned securities or bonds, you know, treasury bonds and mortgage-backed bonds. And I think we peaked at 8.9 trillion. So, and what the blip there was they had to step in and support those banks. And that added $200 billion of Fed balance sheet stuff. So they were supposed to be declining 60 billion a month, and they about a year ago, and they're not there. So that's that other piece that at some point that has to kind of come back down, and we'll see what that does to the economy, because they're essentially sucking money out of the economy at that point.
Well, Tim, we are out of time, but we appreciate you being with us, and we appreciate the fact that we get more than just a soundbite from ISM with both you and Tony. So thanks again for being our guest.
Okay, guys, you bet. Good to have you. Good to be here with you. And I'll see you. Like I said, June's going to be really interesting because that's going to set up the environment for the rest of the year. And,
well, thanks for the good news based on a decline. I'm not sure how everyone's going to view that, but we go with the pro.
Yeah, well, for me, it's like I need some certainty here. I need some. Once I get to certainty, either let the people go or grow the business. It's going to be one or the other. And in June, we're going to kind of see that. Like I said, let's watch that production number. If it comes down 45, 40, anything below 48, then all right, you're going to see a disappointing earnings season with people adjusting their EPS for the rest of the year. And, okay. All right, let's get on with it.
Thanks for being with us.
All right, you bet, guys. Thanks. Take care.
Thanks, everyone, for tuning in to this episode of Manufacturing Talk Radio.